Okay, so first off, I'm trading or not trading today. I kind of finished up some of my trading earlier this week. I've been doing some traveling, and with Yellen speaking on Tuesday and Wednesday, with EIA inventories yesterday, and then with Brexit today and tomorrow, it was just a good week on top of traveling to not be doing anything. And so I could say, looking at some of these charts, where I see some opportunity, where I don't. Just looking here at crude at the moment, I'd like to get a position in crude, maybe a stab further short, but right now, I mean, this thing's is fairly balanced, which, if you understand the idea around auction theory, that the term balance makes sense. If you don't, that doesn't really make sense, but it'll make sense here in a second when we start talking about noise and what do we mean by noise and how that impacts trading performance. If you have any questions about a market or specific ticker, feel free to throw those in the question box, and I'll go after those. But otherwise, we'll just rock and roll. So, what do I mean by noise and how that impacts trading performance? So, noise could be it could be anything. It could be a fundamental report. It could be a news article. It could be a Twitter post, chat room fodder. It's some bit of information that the individual trader needs to be able to discern, is this actionable or is it not? And over and over and over again, when I do reviews of trader performance, I find that noise is a component that drives another behavior that is fairly detrimental, and that is over trading. And here's how that works. So say you come into the trading day and you've got a plan, and you know where you are interested in playing, you know when you're not interested in playing, and then some bit of information comes out that causes you to deviate from your plan. And it's a psychological mechanism. It feeds on the fear of missing out. So you think, oh, there's an opportunity that I'm missing on, so I must act. And the brain is probing you into action, and it's this action that causes you to deviate from your plan that causes the probabilities of success to just absolutely crater. An example would be a trader that I'm working with right now, a guy that has been successful for about 15 years, who is now seeing diminished performance. And one of the key components that we've identified is that in the particular market that he wants to participate in, he wants to know why. Why did price move this way? What's it going to do next? Where is it going? If you find and you hear yourself asking these questions like, man, where do you think the market's going to go? What's it going to do tomorrow? Why did it make that move? Then you are likely prone to noise affecting your trading performance. As silly as it sounds, the traders who consistently show great performance are traders who, when you ask them, what do you think about the market or where is it going, they go, I don't know. They really do. They express no large opinion. They're not tightly held to an opinion of a perspective of where the market's going, but they know where they want to play and where they don't want to play, and they've identified high probability areas to play in, particularly using tools like profiling as a way to do that. But noise is all of these things. So here's a great way to check if you may be impacted by noise. It's how many people are you following on Twitter? Are you looking for trade ideas on Twitter? Are you looking for chat rooms? Are you looking for some bit of information, a fundamental report, an earnings report, something that you think that would give you edge? And I'm here to tell you that all of that stuff will diminish your ability to perform as a trader. The best information that you can lean on to make trading performance, make trading decisions, is the actual market generated information. And what I mean by the actual market generated information, it's the shape and form and behavior of the auction in a given session relative to the prior day's auction, and where does that fit within a larger context. Because for no other reason than this, if you're in a chat room or you're in looking at Twitter, you have no idea of a number of dynamics that are crucial to making trading decisions off it, especially if you're following it like another trader. And they could actually be a good trader, but you don't know the time frame that they're operating in. You likely don't know the account size. You don't know how they're managing risk. So if you try to follow that on limited, very limited information, not knowing what was the impetus by which they got into that trade, you are setting yourselves up to just absolutely get railroaded. Now, if you're attuned to the auction and the behavior of the auction, then you can look at the behavior of the current day and you can make decisions for yourself of where the auction is and where you want to play and what are the probabilities to lean against. So let me give you a concrete example of that. So here is a 20-day crude futures chart, and I'm using crude futures as an example. You could use any instrument that you want. You can use an equity or whatever. I have a number of things that I have represented in this chart. One of them is 30-minute bars for each day. So each histogram here is a 1-day histogram. And then I have a composite histogram. And what these histograms show, we call this a volume profile, but this is how much volume was fired off or transacted at that price within the given time frame. So this is a 20-day chart. So this histogram here is for the past 20 days. So this is telling me that the higher the peak is, the more agreement would happen in the market at that price. This price here at 49.88, that's the most traded price of the last 20 days in this product. So this product being crude, so that's telling me that 49.88, the most transactions took place at that price. So think of it like if you were in an auction yard or someone was auctioning heavy equipment. Like where I live in northern Colorado, if I drive down I-25, there's a big heavy equipment auction yard, and you can get backhoes by the dozen there. And when somebody goes to the auction yard, they have an idea of where they're willing to buy those backhoes from. And the price fluctuates, but there's an accepted price that they want to do business at. This would be like that, except this is crude instead of a backhoe. And the thing that I'm always looking for are, what is the behavior and how is it relative the next day? And I don't really care about what a number is or what the consensus is. And here's another concrete example within that. So we're going to zoom in. Hang on a second. We're going to zoom in on this day. I'll draw a box around it. This day in particular, right here. So that was yesterday, Wednesday, June 22nd. We have a weekly inventory report that comes out for crude oil. Now, this is what we call a binary event. It's an event where we know it's going to move the market and we don't know where. Because sometimes, especially around fundamental information, whether it's a supply and demand change, it could be that the information is already priced in, meaning that the market has already expected what the number is going to be, or it could be that the market's surprised by that. You don't know. No one knows. I think I was looking at numbers from Brexit right now. I think the probabilities are about 80% that the UK stays inside of the EU, but there's a 20% probability that they won't. So everyone's expecting it to do one behavior. There's still the chance that it could do something else, and that's unknown. So what we want to lean against is I want to lean against certainty. I don't want to lean against something that's unknown. I want to lean against behavior that I can actually act on, not something that's just up in the air that could have already been baked in or could be an outside move. So the best information for me is when I look at, okay, well, how was the day that we're looking at relative to the prior day, and what's the behavior? So on the day that we had this inventory report in crude, it actually fired off right here. So this move from $50 that eventually led all the way down to 48 and about a half in the August contract of crude came after the release of an inventory report. Now, guess what? I have no idea what the report said. I have no idea. I don't care. And you don't have to care either. You just need to know that there's an event out there, and what's the what's the expected behavior. So the prior day, we had what I would call a fairly balanced day. And what I mean by that is if you look at, and I can take this alert off, if you look at the profile on the day, this bell curve, there's almost a bell curve here. So those of you who are familiar with statistics and normal distributions and outliers, this is something that shows up in markets. There's research that goes back to the 80s from a guy named Peter Steidelmeier that looked at auction behavior. And again, all of these products that we trade, whether it's Apple stock or Alphabet stock or some penny stock or whatever, they all have predictable and consistent behaviors. And that being, they're an auction. And so when you're in an auction, like if you were in a housing auction or a heavy equipment auction, or you're auctioning a live cattle, there's a place where people are willing to participate, and there's a place where people aren't. And there's anomalies that happen where price moves in unexpected ways, and then there's predictable behaviors that happen to that. So, I mean, think, for example, if it was a housing market, for example, when I go to buy a house, I look at the comps of the houses around me. And the reason for that is because I don't want to buy something that's way overvalued. I'd actually like to buy it undervalued. Well, when I look at the day before this announcement in crude, you can see that this red line right here, which is the fairest price of that day, was about 49.14, and that the histogram was a nice bell curve around that price, meaning that if I sold up here and I bought down here, I was selling above value and I was buying below value, which we would all want to do. We all want to buy, something undervalued, and we all want to sell things overvalued. This tool allows me to see that happening in real time. So it's not just like a moving average or a trailing historical instrument. It's actually a real time as the auction is taking place. And so I can actually start to see opportunities shaping up before they happen, not after they happen. Now on this day, we got a late spike late in the day. You can barely see it. There's a green line down here to where we closed that ate into the prior day. But I'm always looking at the relationship of the current day to the prior day, and how is that behavior. So for example, on Tuesday, we notice that from Monday's trade, it's not quite as nice of a round profile. It's got a little bit of you could almost say it's got like a P shape to it, but there's a little divot in here. So there's almost two distributions within this auction of price. The next day we open below it. So however the consensus of value was on this day, the next day the consensus was, we're starting lower. So if you have an auction where price is accepted at one place, and then the next day it opens either above it or below it, you have to start thinking, well, then what's the mentality behind that? What are people thinking? If I was looking at one house that sold, in a market at 300K, and then the next house sells at 280K, I go, what about the next house that sells? Does that house sell at 280, or does it go back to 300? If it goes back to 300, then I know that we're accepting prices higher, and if the next house is 260, then I know that we're moving away, and price is moving away from whatever the acceptance was. So that's the behavior that I'm looking for. On the day before this inventory report, we're getting there. Stay with me. We started out lower than the prior day, and later in the day we decided, no, actually these prices up here are still valid, and we moved back up. In fact, we closed back in there. So this set the stage for the following day being higher. So this open up here should not have surprised anyone. And the reason why it shouldn't surprise anybody is because, again, think about this. If I'm at an auction and the auction tries to go lower and it finds buyers, it's not going to keep going lower to find more buyers. It's going to go higher. It's going to go higher until it can't find any more sellers. So if we had a consensus around what the value was, and then the next day we go lower and we try to find, if we can auction lower, but that gets bought and it gets bought back up to where there was consensus before, then the next predictable behavior is that we're going to go higher to see if we can find sellers. Okay, so This open here should not have surprised anybody. That was the expected behavior. Now you don't know, how's it, is it going to continue in that fashion? I mean, it could continue based on, okay, if it keeps selling, can I find other people that will sell higher and sell higher and sell higher? On that day, we started up higher, and then we're not really moving, we're moving sideways. Now this is a predictable behavior because we were anticipating a move coming off the inventory report. Now again, you don't know, is it going to go up or go down? But we know that this move is coming out. The news gets released, and then if you watch price, it comes back into a known reference. It comes back into a prior area that has been accepted, trades very, very fast across that, and then even gets into this area to accept it. All of that is telling you that wherever this price was up here, that we found all the sellers that we needed to then auction back across this. Now, this can look like, like if you looked at this on a candle chart, you'd go, oh, well, this is an outside day, so that means the next day that we're going to go lower. But you'd be wrong, because all it's doing is it's just going back across price that we've already done. We're basically just going sideways, and we're retesting and examining, where's price. And here's the part that the profile shows you that like a candle chart won't even show you as well, is that see where this Ferris price ended up being after the inventory report? It's the same as the day before. Now it might be a different story if this Ferris price ended up and closed down here, because then that would be outside of these prior references, but it was in line with it. So all these guys who got late short down here that were selling from 48.82 to 48.37, I mean, these late shorts down here were setting themselves up to get a snapback back to an area of reference. And we in fact did today. And now we're back balancing. So what we're doing in total is we're now starting to build an area of price where there's lots of consensus. It's almost like it's a composite across these 4 days. So in terms of what's going on next, again, I don't know. Is oil going to go higher? Is oil going to go lower? Is there lots of supply? Is there not lots of supply? I don't know, and I don't really care. But what I'm going to look for is I'm going to look at behavior above this 50.28 level, and I'm going to look at behavior below this 48.88 level. Because anything inside this, there's been some agreement that that's a valuable price. And just like if I was participating in any market, whether it's a housing market or I'm shopping on eBay, I want to buy something low and I want to sell something high. I don't want to buy in the middle. I want a deal. And this, I'm already starting to establish the parameters that show me where the deal is. And I can do this, and I don't need to watch Twitter, and I don't need to watch CNBC, and I don't need to watch Bloomberg, and I don't need to read the Wall Street Journal, and I don't need to be in a chat room. I can just look at the behavior of the auction as it's taking place and focus on the areas that I want to play. Think how much of your life you'll get back if you could just look at the auction and make decisions that way and not get caught up in, well, which way is it going to go? What do you think about it? Because here's the thing, a lot of people that are putting out their opinions either don't have a stake in it, or they're monetarily incentivized to suggest a certain stake, or they're just completely wrong and full of it. I mean, is that who you want, just giving you information about where you're going? Or do you want to look at the real data in the auction and make decisions that way? I for one, like to do that. It has made my life so much more simple because I can just look at the auction and I can pick the spots that I want to play, and I can just tune everything out. Now, it does require discipline, because if you do have these other streams of information around you and you could see something that then calls into question what you're seeing in the market, and that will mess with you psychologically and provoke you into acting on the fear of missing out and entering trades that you probably don't want to be. Early in my career, I found myself all the time chasing trades and managing trades that I had no business being in, because I saw somebody that I thought knew what they were talking about, and so I'd follow them into a trade, and I lost a lot of money doing that. And so as I have moved and developed the discipline to just pick the spots that I want to play and the days that I want to play and in the auctions and products that I want to play, my performance has skyrocketed. So that's my soapbox. We're a little ahead of time. If anybody's got a question or wants to look at a specific example, or even like pull up a ticker and look at a specific product and say, okay, for what just the market itself is saying, the auction that's taking place in that product, what would be places to play? We could have that great conversation. If we don't have any questions like that, then I'll jump off and get back to doing whatever else I'm going to do. All right. Yeah, great question, Jed. So the question was, how can you cover, or can you cover how the profile develops targets as well? Yes. So here's a great. Let's see. Let me rack my brain here real quick and talk about if the data allows me to pull this up. Thinking. See if I can pull a different product up. Well, if this comes up, we'll talk about it. I'll describe the concept in loosely, and then if we can see the graphical example of it, it'll be great. But if we have a day that is a balanced day, like we're looking at that one day in crude, and the next day we open inside the range of the prior day, and say the day is and what I mean by balanced day is it's a day where that profile looks like a nice bell curve, and we open the next day inside of that as a balanced day, then there is about 1,400 trading sessions of data that suggests, that's about 5 years worth of trading data, that says that I can project the next day's trading range to be about the same range, give or take 5 or 10% of that range. So yesterday in the NASDAQ, I think the range was about 30 points. Today we opened inside of the range. Awesome. We opened inside the range, and we spent the first hour inside of the prior day's range. So I could then start to predict that the range for today was going to be somewhere around 40. I think it was 40 points. So somewhere around 40 points. So the low of the first hour was 43.97. So I was looking at 44.50 or 44.60 as an area to sell. And that was an area of interest. And again, you add about 5 to 10%, that gets you to 44.60. Which if you had actually sold in the 44.50 area today, you would have done well. You would have been able to pull an easy 10 points out of the NQ. So that allowed you to have a great entry. Or if you had bought at 43.97 and said, hey, I'm going to make a bet that this is the low of the day, you'd have made 40 points. Because you had in mind, here's a potential target that's out there, based on the behavior. And that's just one example of how you can look at an auction, what the accepted auction is, and then make a projection of what the next day will be. And again, that's total edge, complete and total edge that nobody else can tell you. Everybody else they'll look at pivots on candles, they'll look at moving averages. And that stuff, people will laud it because there are times that it works, and we can all find exceptions where it works. I'm more interested in what's got the highest probability, and working off of that. If we had a day where the profile was, hang on one second, guys. What I'm gonna try to reboot the software and see if I can't get it to display what we want to see. If I had a day where the market was really stretched and that profile was really thin, I'm seeing an unfair high and unfair low, and that gives me a place to look at a potential trade back toward an area, and then I can see it as, so the further I get away from one of those most accepted prices or bounce areas, those can become targets the further I get away from them in trading back to them, because they can act like or like magnets as you're going back. Yeah. So for example, here we are. We're looking at the NQ. We're looking at the NQ. I'm sorry. Look at the NQ trade yesterday. So prior day is this got this nice balanced profile. The next day we open and spend the first half hours, first 2.5 hours inside the prior day's range. So if that range was 43.88 up to 44.14, that gives me about 30 points of range. So on this first hour, the low was 43.97. I could add 30, 40 points to that. I get up here, which also has an area up here that's a target and a likely test. So that's a nice target if this holds as the low of the day. It was also a place that you could get short and get a nice short back into a prior area. Great question. Any other questions? Next question was, how do you define risk? So defining risk is, and I know it's something with the students that we work with is they almost get tired of hearing it. I see guys that come in and they say, hey, I have a goal to make X each day, and I don't think that that's a tenable position. I think the better position is to say, how much am I willing to risk, and where do I know that I'm wrong and need to reevaluate the position? And that if you come in with that position, then the profits tend to take care of themselves. So let's say, for example, that we were looking at, again, this, not today, but well, let's look at actually today in the Nasdaq. So we had a trend day, and I say it's a trend day in the fact that we, from this open price, we never visited again this low of the day. Actually, did we open? Yeah, we opened at 44.30, came down, tested value of the prior day, and then drove in the other direction. So that's a known behavior of and tells you what's a likely day to form as a result of that. An open, test, drive. So if we open, go down, test a known level, and drive in that direction, that gives you an expectation of what the day will look like, which is a trend day is a high probability. And on a trend day, I don't know, I can't make an expectation of what the range is. There's other ways to look at possibilities there. But say I got in, I saw the bounce off of value area high here at 44.12. And what I mean by value area high is this, from this yellow line to this yellow line, 70% of the trade of that day took place inside of that area. So if you're familiar with statistics and you think about normal distributions, that's your normal distribution on your day. That's the place where the most business took place. So anything above or below that could be an unfair high, could be an unfair low. And that is an area that often gets retested in successive auctions. So if you want places to look at as a potential test, and what I mean by test is that a market comes back and says, hey, is that price valid or not? Or was that an anomaly? Those are levels that are often retested. More so this point of control, this fairest price, than a value area high or low. But if you're looking at today and you saw us open above the prior day's value, but we're inside of the prior day's range, we come down and test value, and then we turn. So at that place, you could have bought this auction, and you would have said, okay, how much am I willing to risk? I mean, for my part, I would have been willing to risk down to 44.04 because I would think, okay, where would I be wrong? If my bias is bullish on the day, because I look at this initial rejection off here, my bias is bullish, what would tell me that it was no longer bullish? What level or price, if transaction would shift that bias in the day? And that would be is that if you think about it, auction opens higher, comes down, tests a price, then drives away, but then if it fails and comes back to test a price again, then that's telling me it doesn't have enough gas. There's not enough willing buyers to make that thing go higher. so it's going to fail. So I would have defined the risk zone from 44.12 down to 44.05, and you can be in your stops, but I would look to see if we got acceptance back below this point of control as a place to get out. Now, from it, what's great is that I'm basically risking about 10 points that I've defined as the risk, what I'm willing to risk. The entry, and the entry probably would have been more here at 44.18, so I'm probably risking more like 20 points. But the return or reward for that was from 44.18, and given it as a trend day, I would have ridden this thing at least probably to 44.41, and I would have taken some off, and then have some runners to go later. The reason I would have taken some off is because often trend days do balance at the end of the day. There's day traders that jump on the trade and they have to balance their inventory and get out. So that's a place where they can sell and end the trend. So I would have tried to be in front of that. But that would have given me 18 to 40 40 points. So it would give me 20 points in risking about 18. But people get hung up on risk return ratios. I know there are people that say, oh, it's got to be a 1 to 5 risk return ratio. I don't actually see a lot of places where that really works that well. I find it much better when you say, hey, look, this is what I'm comfortable risking. And if you're disciplined within those risk parameters, you can do well. That trade would have done well today. But again, I didn't trade again because I'm traveling, and there was Brexit stuff, so there was a degree of uncertainty within the market that I just didn't want to mess with. But great question. Any other questions? Well, while everybody's thinking about questions, I want to look and see how the euro is doing at the moment. I'm going to turn on overnight trade. Nothing too crazy. Let's look at the pound here. Yeah, nothing nuts so far. Here's another self-test to know whether you are addicted to the noise. If your plan is to stay up tonight until 3 a.m. to see returns from the Brexit vote, you may be a noise junkie. I am not. I'm going to sleep, and then I'll take a look at markets tomorrow. All right, we'll sleep well. All right. Any other questions? Any other products or stocks anybody wants to take a look at? I'm happy to do that. Oh, that's a great question. Okay, so question was, do you correlate anything like volatility with noise? No, actually, I look at volatility as a very actionable bit of information that I can use and act on the hard right edge. And what I mean by the hard right edge is that as in trading, as any other business, we're trying to identify opportunities before they happen. Which often, I sometimes get accused of being contrarian. I'm not a contrarian. I'm just trying to get in front of the turn, so I have the best opportunity to seize the. I don't want to jump on the trend. I mean, in the other businesses and stuff that I'm at, I like to be the early adopter. I like to be the early majority. I don't want to be a laggard, because that's where you get hurt, especially in markets. The laggards always get hurt. The guys who jump on the trend last are the ones who get crushed. Case in point is if we were to look at corn futures, and I apologize if everybody trades equities. I mean, I spend all of my days in futures, and that's a way that I can eliminate noises because I can simplify the products that I'm playing on. But so this is the futures market. This is a weekly chart So each of these profiles is 1 week. So if you look at this week's trade, you can see that we have traded back across 1, 2, 3, 4, 5 almost. So basically the last month of longs are now underwater. And this move right here, though extreme, was not unforeseen. The implied volatility, and implied volatility is what's set on every trading instrument based on the expected range of that underlying, and it's computed on the prices of the option market. So it's a fantastic tool to use because you can use a very simple formula that is the settlement price times whatever trading range you want to look at times the implied volatility percentile times the square root of 5 divided by 252. And the 252 is number of trading sessions in a year. That gives you an expected range. And you can take that range, cut it in half from a settlement price to give you a range of, it's almost projecting what is the normal distribution, the expected normal distribution of trade. So about 70%. 70% probability will stay within that range in a given week. So, for example, if I look at, I'll have to pull up the old contract, but if I look at corn weekly, you will see this yellow line here at 37 or 377.53, $3.77 because that corn it's in bushels. But this yellow line I painted on Sunday. And I painted that yellow line because the implied volatility of this instrument said that with a closing price up here last week around $4.33, that it was possible that we would see $3.77. And when you were up here, you'd look at that line and go, well, that's ridiculous. And yet the options market, which is a highly efficient two-way market, had priced in the possibility of a move like that. So I don't look at volatility as noise. I look at volatility actually as a way to front run and parse out noise. And if we're talking about implied volatility of what the market's projecting. Now, if you're looking at just moving, like the market moving around and being volatile, that can be a measure of noise. If we look at crude, for example, and we'll go back to a daily chart, and we'll look at not this Wednesday, but the last Wednesday, where we had an inventory report. You can see these. It happens on every Wednesday. If you look at every Wednesday in crude, you get this like spike. There was this initial move here, and then it kind of gyrates around before it settles down. I mean, that can be a form of noise as well, because what's happening there is a number gets released, and then everybody's trying to jockey and get in position, and then the computers will run everybody out. They'll run them out to the short side, they'll run them out to the long side. They're just going to try to confuse everybody. So in that sense of volatility, I would absolutely call that noise. And that's where I don't try, after a number happens like that, I don't try to get a position. Let them shake them out. Stay on the sidelines, let it settle down. You have a much better probability of having good performance. Great, that's a great question. The VIX, by the way, if you're unfamiliar with that instrument, this is a measurement of the volatility, the expected volatility within markets in general. This is correlated to the S&P. So this is an instrument that measures the volatility of the S&P and its options, but then is a basis by which all other vehicles are their volatility is connected. And just kind of looking to see how it's doing at the moment. 1743. So yeah, they're pushing this thing. This is the continuous chart, so you can see, yeah, wow. This is awesome. So I'm actually, I'm very much intrigued by this, and I would love a lower VIX to buy. With the idea, especially because VIX is a mean reverting instrument. You can see after of the last 9 months of this contract that the fairest price is 1940. It's likely we'll come back and revisit that. So especially again after the Brexit vote, if we're still down here, I may be looking to accumulate VIX to go back up to 1944 or at least 1828. I mean, those could be high probability trades. Not necessarily, those are not day trades, but that's something that I would probably be looking at. So where's the spot VIX at? It could fall a little bit, so I'll wait. Any other questions? Oh, thanks, man. That is fun. All right, I'll stick around here for 3 more minutes, and then we'll wrap it up and post a webinar on the website. And again, I'm okay to do these about every other week. I don't know that I'm going to do these every week, but if we can help filter out the noise for traders and hone in on a specific view of the auction, I'm happy to do that, because the reality is that 90% of traders fail. I'm here for the 10% who want to succeed or who want to succeed and help them really drive performance. And every day I see lots and lots and lots of poor performance, and a key component of that is noise. And it's one of those that's not recognized, even in the sense of how many people showed up for this webinar. Because they think, oh, noise, what do you mean? That doesn't mean anything. That's silly. That's a silly topic to cover. Why aren't you covering some technical setup or stuff like that? And this, I think, uncovers one of the reasons why so many traders fail, is because they are more concerned with a trading setup than they are with the overall rationale of the psychology behind what they're doing. So for those of you who showed up today, you are already separating yourself from the herd, which is good. All right. Well, I'm gonna go grab some dinner with some friends and have a great night and look and see whether the Brits made a fantastic move or not. And I won't tell you which way to vote I think is a fantastic move, but we'll see. It'll be fun, and we'll talk to you guys next time. If a couple things I did want to make people aware of is if you want to help filter out the noise and be with a community of traders who are really trying to get noise out, we do have a Slack channel that is fairly active, and we've got some really competent traders in there, along with some great students that are learning, and happy to give you a free invite inside of that. You just got to make a request, and then we can send the invite to you. But that's we're trying to support cleaning up the noise by offering an opportunity to be in a space where there's less noise, so that you can just focus on trading. Okay, that's it. Thanks, guys. Thanks for making the time, and we'll catch you in a couple weeks.